Hi everyone, this is an alternate version of exercise 4-3. Let's take a look at the problem. The problem reads, prepare journal entries to record the following transactions for a retail store. Assume a perpetual inventory system and the gross method. So we have several transactions and we're going to journalize each of them. Let's take a look at them one at a time. The first transaction, April the 2nd, purchased $5,400 of merchandise from Lion Company with the credit terms of 215 and 60. So that means a 2% discount if paid within 15 days. Otherwise, the net balance is due within 60 days. The invoice is dated April the 2nd and it's FOB shipping point. So remember, title changes at shipping point. If it changes at shipping point, then who's responsible for the shipping cost? The buyer is. If it changes at destination, who's responsible for the shipping cost? The seller is. So in this case, the merchandise inventory of $5,400 is an increase to merchandise inventory. Since this is bought on credit, accounts payable, $5,400 goes up as well. So we show the merchandise inventory with the debit and accounts payable with the credit. The next transaction paid $500 for shipping charges on April the 2nd for the April the 2nd purchase. Merchandise inventory then increases by the cost of that shipping. It's part of the cost of the inventory, so it's going to increase with a $500 debit, and cash will be credited for $500 as well. The next transaction returned to Lion Company unacceptable merchandise that had an invoice price of $800. So our inventory is going to go down, and what else is going to go down? Our accounts payable will also go down. So accounts payable will go down by $800, and our merchandise inventory will also go down by $800 with a credit. The next transaction sent a check to Lion Company for the April the 2nd purchase, net of discounts and the returned merchandise. So several things have happened here. First off, we have to total what the balance is that's owed. We want to bring that down to zero. We had an original $5,400 purchase, which was a credit, the $800 debit for what was sent back. So we're going to need a $4,600 debit to bring that balance down to zero, to pay the balance off in full. So we know that accounts payable will be debited then for $4,600. Merchandise inventory, well, we're going to take that 2% credit, so that's going to lower the cost of the inventory. And the balance is going to be the plug to cash for $4,508. So we're going to further lower our merchandise inventory. This was the cost, this was the shipping cost, this was the cost of the items we bought. This is what was sent back. It's lowering our overall inventory cost. The credit, they've lowered the purchase price of the inventory, so that's lowering the overall cost of inventory as well. And then cash gets credited for how much we owe for the purchase, $4,508. Okay, a few things happening there. Let's take a look at the next one. Purchased on the 18th, 7,000 of merchandise from Frisk Corporation with terms of 110 net 30, so 1% within 10 days. Net 30 otherwise. Invoice April the 18th, FOB destination. Who's responsible for it, the buyer or the seller? Well, FOB destination title transfers where? At destination point. So it changes at the buyer's destination point. So therefore the seller is responsible for the inventory that's en route to the buyer. Transaction, inventory gets debited for $7,000 and accounts payable gets credited for $7,000 as well. So update the inventory, update the accounts payable ledger to Frisk Company now. After negotiations, received from Frisk a $1,200 allowance towards that $7,000 purchase. Well, there must have been something wrong with the stuff that was bought, so the company says, well, we're going to knock off $1,200 off the price. So they no longer owe $7,000. That gets reduced by $1,200. And the merchandise inventory gets reduced by $1,200 as well. So the price gets lowered by $1,200, the accounts payable with a debit, the inventory gets lowered now by $1,200 as well. Moving right along then on April the 28th, sent check to Frisk paying for the April the 18th purchase, net of the allowance and the discount. So we want to bring this balance again down to zero. We have the purchase price of $7,000, the allowance of $1,200, so we owe them $5,800. So the accounts payable gets debited for $5,800 in our journal entry. Merchandise inventory, we're going to lower merchandise inventory by the amount of the discount. We get 1% off $5,800. Remember, since we return some stuff, it's only how much we actually have to pay them that we take that discount on. So that's a $58 discount, nice big sizable discount of 58 bucks. That's lowering our overall inventory cost in by 58 bucks. And then the difference between these two will be a credit to cash. So we have to settle up for 5,800, but we get our discount of 58, so we only sacrifice cash of 57.42. So lower that inventory by 58 and lower the cash balance by the 57.42. So total things up, and what our cash balance looks like, it's a deficit because we never had that debit balance to begin with, total merchandise inventory, and that concludes this example.